Ahead of what's going to be a very busy week for earnings, as well as some big a big GDP number that's coming out at the end of the week. It's a busy week, and we started off with our third down day, kind of down day on the S&P 500. So I'm going to break this down to see, is it changed the narrative that we had in terms of our expectations going forward on the S&P 500 from last week, or are we still on pace? Are we still on track? For that short-term bounce. I'm going to break the technicals down. I'm going to break down a big move that happened in one particular asset class that could change some long-term expectations there, and look at one of these earnings that's coming up this week for a trade idea. So let's go ahead and get started. Today is Monday, April the 23rd, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those of us that are watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel. Click on the logo that's down in the bottom right corner of this video. You'll hit that red subscribe button there. Also, hit the thumbs up icon that's down below the video. That lets me know that you like the video today. It lets me know you want me to do it again. Comment on anything that stands out to you. You have to scroll down further below to comment down on the YouTube channel. Of course, join our daily Market Outlook email list. You'll see a link to do so in the video description on the YouTube channel as well. Follow me on Twitter for more content in addition to this video. You see my handle up on the screen at DavidSettle42. Like and retweet tonight's Market Outlook tweet, always pinned to the top of my timeline. Join our Market Outlook community on Facebook. The handle's up on the screen there. We are just literally a few people away from getting to that magic 1,000 number. So if you haven't joined our community, you do that tonight. You can do that also with the link down in the description below. All right, let's take a look at the S&P 500 then with the market forecast indicator first. You can see the near-term line, we were a little up today. Not even a point. Not even 0.2 of a point. So 0.15 of a point here. So that's why the candle's not red. But essentially it was pretty much a down day. A late rally at the end kind of got us up off the lows of the day. It turned the intermediate posture bearish. Now it's right around the 50 mark, so it's not really too bullish. It's not really too bearish either. We are just barely crossing above 50 as it was. We did get a higher high. We're still got the possibility of forming this higher near-term low point, right? So if you were to come off this near-term low, the last one we had right here, and I define near-term highs and lows as anytime the near-term line gets above 50, anytime it gets below 50. So if I were to do something like this, you can see we're still technically sitting right about that 38% Fibonacci retracement on a closing basis. So still kind of forming what could be a higher near-term low. Now we are 2 days below 50, so if we are going to come off this low point and continue to be bullish, we need that near-term line to bounce up and get back above 50 here. It's usually only spends about 1 or 2 days below 50 when it's forming that low point. You can see here, we were starting to form a low point. We were below 50 for 1, 2, 3 days, and then we had fourth day, and then even though it was still going to be a higher near-term low, we spent too many days below 50 on the near-term line, and so it ended up kind of cascading here. So same thing, we got 2 days now below 50 because that one's a little bit above it. So 2 days below 50, still at a decent support level. We need to bounce off of this, get above that trend line. We're going to be bullish, and this will have that 1 to 3 month range that we've talked about before. This market sentiment line is not going to turn up like a V bottom. It takes longer. It's a longer time frame. But we'll see. So as of right now, the expectations are still there for a bullish bounce off of what would be a higher near-term low point, off of what would be a bullish near-term low point, because of the fact that it didn't get below 20, and it came down, albeit very briefly, but it came down from a peak that did get above 80. It's not too bullish, but it was a pretty good higher high that we got on the S&P 500. Let's take a look at the Dow Jones Industrial Average, which has had a few of its components kind of struggling here. You can see how it did get above that trend line the S&P is kind of struggling with, and it's also setting up for what could be a higher near-term low point as well. So you can kind of see here it's a little different. It's been a little bit flatter, but you can see still sitting itself as well on that 38% Fibonacci retracement of that previous bullish near-term run that we've had. And then finally, you look at the other two major components. The Nasdaq, same thing. You could also draw the same Fibonacci lines coming off its last near-term low point. This one getting to the 50%, but it's, you see, for the S&P, the 38% is the one that lines up with that peak, the equivalent near-term peak there. On the Nasdaq, it's the 50% Fibonacci line that's lining up with that near-term peak there, and its near-term line did get briefly below 20. Not too bearish. And you can see the intermediate line is smack dab right on 50. So again, not too bullish, not too bearish either. Very, very neutral from that regard. And then finally, the Nasdaq, or the Russell 2000, which has been more bullish, its near-term line also dropping, dipping its toe below 20. But remember, it has been more bullish than the other indexes. And again, you draw the same Fibonacci retracement, and we're easily sitting on top. If that near-term peak is sitting at the 50% Fibonacci too, it's crossed above that trend line, whereas the S&P hasn't yet. And then, of course, you can see still holding that 60% Fibonacci retrace, or 38% Fibonacci retracement for support. So despite the bearishness in the short term, they're still setting up for that bullish bounce. And you expect support to hold until it doesn't. You expect when you come down from a higher high that you bounce off a higher low until you don't. And so the expectations are still there because we haven't continued to break down yet. Now, it's a big week with a lot of earnings coming out, so we'll see with our trade idea of the day. So that can impact a lot of this. But the technical picture heading into this week is still short term, still the beginnings of an intermediate rally. That's still setting up for that rally or that trend to continue. We haven't had enough evidence yet that would suggest that this new intermediate trend doesn't have enough legs to it. As a reminder, for those that are watching this embedded in our blog, in our Market Scholars blog, there's 3 clicks I want you to make while you're watching. One is to like tonight's Market Outlook tweet on Twitter there. You can click on that heart. You can do it right here while you're watching. Also, if you have a Facebook account, click on that thumbs up. That will like it on Facebook. Again, when you do those 2 things, it tells me, number one, that you want me to, or the third click, sorry, is to click on the like button right there. It's even bigger for you to see. When you do these 3 things, it tells me that you want me to keep doing these videos day after day. So 1 click, great, easy way to give me feedback. Number 2, it tells Twitter and Facebook that you think that this is good content. And the more they hear that from its users, the more that they will want to push this content out to the rest of the people who follow me, as well as anybody else who might follow this type of, or look for this type of content. So it's almost like it's your way of recommending, whether you have followers or not. Clicking those 3 clicks is your way of recommending the Market Outlook with really easily. Now, really quickly too, I wanted to mention that this link up here takes you to the forums. So if you have any questions or want to comment with other users about the Market Outlook video or the trade idea, whatever, you can do that in the forum. And we do have that promotion. We're giving away 5 gift cards as of May the 5th. The promotion ends on May the 5th. So anytime you engage in the forums, anytime, you are eligible to receive one of these 5 gift cards here. Of course, the more that you post in there, the more likely you are to win one of those. So just wanted to make sure that you knew about that. You can see we continue to trade here on the long-term basis. You can see the trend line here. We continue to trade on a long-term basis right around that 50-day moving average is just flattening out. The 200-day moving average is also kind of flattening out. The gap between the two has been shrinking, but even that shrinking has been slowing down. A lot of times when you get this coming down to zero, you'll get ups and downs. So we've really had a steep, we went up quite a bit. If you take out that kind of bulge right there, that came from this kind of tax reform related abnormal bulge there, then you can kind of see a steady move to the downside, which is what you normally get when you are this far up above the moving average and we start to grind our way lower. So don't be surprised if we don't slow down, turn up a little bit, roll back over and continue to grind our way towards that 25-50 point area when things really start to, and everything really flattens out after such a steep, long, extended bullish run. Take a look at the Russell 2000, which has been the more bullish component. You can see how on a long-term basis it's been consolidating as well, and it hasn't been its MACD didn't get so bullish like the S&P 500, and you can see it's been grinding with some ups and downs towards 0 too. Well after getting its golden cross in mid 2016, and there's your election late 2016, and a little bit of a weakness in 2017, more than we saw in large caps, only to hit that 200-day moving average bounce and touching the 200-day moving average a couple of times here, trying to form this little consolidation area. And again, consolidation areas, triangles like this, are considered continuation patterns of the move that you had heading into that consolidation. Now, unless it's like a double top or a triple top or a head and shoulders pattern, those things. But when you see triangles, lower highs, high, these kind of or flag patterns or wedges, they are considered first and foremost continuation patterns until, of course, they aren't, until you get a breakout in the unexpected direction. You take a look at the 3 green arrow chart. You can see we got 1 red arrow, so we are below the 30-day moving average here. And let me hide these drawn items for a second. We are below that 30-day moving average, sitting right below the 8-day. I mean, they're all converged on top of each other. The 8, the 17, which are the 2 lines used, and these are exponential moving averages, the red and the green. They're using the MACD. The 30-day moving average has been declining. The MACD and stochastics have both declined towards or below their moving averages. So we're getting some short-term weakness here. Again, not enough yet to say this pullback is anything more than just that so far, just a pullback. And again, you expect support to hold until it doesn't. You expect, when you come off a higher high, you expect to come up off of a higher low until you don't. And because of course, nobody ever knows what's going to happen. You can only expect what you see on the chart and what you've seen in the past. You can kind of see how the high of the day was not early. In fact, we gapped up and went up to a high relatively in the middle of the day. And then, once Europe closed, things kind of sold off and got back to what's actually a slightly lower low than what we saw on Friday, before bouncing up and getting back into the middle of today's range, lower end of Friday's range, up above last week's low point. And remember, from a 4-week range, we are still in the upper half of the chart. I mean, look at that. As time passes, the low point's moving closer over here, the 4-week low is moving further over here, and the 4-week high is moving further over here. And that's a bullish pattern when you see that. And as of right now, as I mentioned, there's that line drawn off that Fibonacci retracement. We're testing that 38% Fibonacci retracement level here of that previous bullish near-term run, which there's multiple highs at 266 that are acting as support level, as well as this Fibonacci retracement zone. Keep in mind too, that as bearish as today was, a 2.5 point range with volume at 65 million shares trading hands ahead of a busy earnings week. 2.5 point range is down here, bringing the line down. 65 million shares traded is down here, bringing that line down. When these lines go down, it's bullish. It's not bearish. So, as bearish as today might, 3-day losing streak, but both lines are dropping. So again, nothing more so far than a pullback, a short-term pullback, depending upon, of course, how the market responds to different earnings that come out this week. But aside from whatever could happen out of that, because nobody knows what's going to happen with these earnings releases, from a technical perspective, we expect that we'd have a bullish week, at least bullish bounce off of that, however long that takes, whether it's just through the end of this week or even into next week. The volatility index is trading right around 17.5, so trying to looking like it's figuring out whether to peak or fall or break up through. And remember, if it does go up, 20 is going to act as definitely act as a resistance there. If you come back over here to the action, this is why we haven't been too bullish yet. If you look at the actual relative VIX to the longer term 3-month volatility index, you can see it's at 94%, so still in the neutral zone, so not bullish, right? The intermediate lines kind of fluctuating around 50, not too bullish, but not bearish either. While we started up higher, you can see we gapped down and got back into that neutral zone by the end of the day. It's 90 to 95%. You can see the importance of getting below 90 to establishing the bullish trend and staying bullish for a while. All right, now we transition on what's driving this price action. And you can see from an economic calendar today, we had existing home sales come in pretty strong, considering how much these mortgage rates are rising and how fast they're rising. You're still you're holding up pretty well. It usually goes down. Usually comes up and holds up really well when mortgage rates fall, and there's some weakness when you get a rise. And I mean, yeah, we are getting a rise, and we might get that weakness a little bit after the fact once they get so high here. You can see that's when we had some weakness. So we'll see if that ends up being the case. Right now, you're still in strength mode for these, and you can see the price still beating inflation pretty significantly, 6% year over year. Of course, everyone's looking at the GDP is coming out later this week. GDP numbers coming out on Friday. You get one more change in that estimate, which is at 2% right now. Over here, you'll get that from durable goods and inventory sales that are coming out. Tomorrow, you have consumer confidence. From the conference board, you have new home sales. Kind of goes in conjunction with these existing home sales. That's your big news announcement. Of course, the biggest thing that's coming out here this week is earnings, and it's a big earnings week. You can see tomorrow, on this is what's on tap tomorrow morning. You can see 3M, Coca-Cola, Verizon, Lockheed Martin, Caterpillar, Eli Lilly, a lot of big names coming out. Freeport McMoran down here. I mean, you can go all the way down this list. Corning, these are all large cap companies. Then you look at on the 25th, you've got some big names coming out here too. Oops. Eventually, here we go. You can see Facebook, Visa, AT&T, Boeing, Comcast, PayPal, Qualcomm. Lots of big names coming out. Ford, eBay. So big week for earnings, and these are usually the 3 days. Tuesday, Wednesday, and then of course on Thursday, I usually get a batch. You don't get very many on Friday and Monday, but you get your big batch on Tuesday through Thursday, and you can see Microsoft, Intel, Amazon, all your large cap, Baidu, Starbucks, UPS, UNP, some industrial names in there, Amgen, another healthcare, Pepsi with an Altria, some consumer staple names. You can see ConocoPhillips, Time Warner, lots of Valero, lots of large cap. I mean, look, you have to go all the way down here to get to around 10 billion or so. There's DR Horton down there. There's a lot of big names due up this week in the next 3 days. So that's really what's going to drive a lot of price action here over the next little bit, and consumer sentiment. You can see from a broader standpoint, the dollar continues to be strong. The dollar had a really good day here on last Thursday and Friday. You can see Thursday not so much, a little bit of a rally, but then it was Friday, and then you can see here's today. So this 3-day run the dollar's had, obviously putting pressure on gold, putting pressure on emerging markets. Those are the two asset classes that do the worst when the dollar rallies. And if I were to take a look at a chart of the US dollar right now, take a look at this here, you can see we're with today's move getting up above this upper Bollinger Band. We haven't done that in a while. We haven't got above the upper Bollinger Band since late October when we had this bullish trend here for a while. We pulled back and we've been consolidating. A little bit of a breakout move on the dollar index. In fact, this is the highest close that we've had over the past few months. So does this kind of change some things up a little bit? Are we gonna? You notice we've got a higher low point here from a broad perspective. If I were to take a look at a long-term chart on this and look at the 50 and 200-day moving averages, there's your triangle that we've been watching, and we've kind of broken out of that. There's an old low point right there that's going to act as a resistance level. The low of that week was 91.01. We're a little bit of, we're just right about there now. The close of that week, which is more important, 91.32. So in that 91-ish area, We'll see if that ends up being a resistance for this. You can see we did pop up here off of that low point, off that lower low. We popped up to here. Let's draw this. Like we were kind of flat until this move here. That's when we really started the downward move. So we got up to that, and that's where you draw the Fibonacci lines, right when you kind of have that breakout move. So this is the breakout move that got us out of this sideways range. We got to the 38% Fibonacci retracement there, found some resistance and rolled over. So let's clear that drawing, and then draw Fibonacci lines now on this breakout move. It started here from this lower high and came down to this lower low, and you can see the 38%. Whoops. The 38% Fibonacci retracement level, there we go, right in this area, is right here at the bottom end of that low point. It's kind of about where we're at right now, and you can see the 50% retracement kind of gets up to that low. So in this area, you're going to find some resistance similar to what we found right there. That also happened to be between the 50 and 200-day moving averages. So it's a breakout move in the short term. It's not quite breaking out completely. You don't trust. When you get these moves off of lower lows, you need confirmation to really say, okay, I feel good about this trend reversing. It's on a bearish trend here. If I can get this drawn here, I'm trying to draw the best fit trend line as I possibly can across these highs. Let's see if I can't. Oops, excuse me. Activate that drawing. Trying to get as best fit line as I can, and you can see we're kind of breaking up above that line with this. So we're breaking out of this triangle. We're breaking up above this downward trending slope line. That last layer of resistance to really feel good about a change in long-term trend will be to get up above that one, that low point there. Now, we could, if that happens, then the possibility of an inverted head and shoulders pattern really starts to rally up. You'll hit some resistance up there too, and we can come down to what could then be a higher low point, and that would be your inverse head and shoulders. So, and you can also see too from a long-term viewpoint, if I move this out longer, a little bit of a divergence pattern forming. That, with that kind of triangle move that we've been getting, wasn't so bullish, but now with today's little breakout move, that might be showing us a little bit more. So definitely keep an eye on this last layer of resistance. Again, 3 different layers. One being this triangle, and the second one being this trend line we've got coming down, and then the third one being this Fibonacci resistance of this bearish move. This Fibonacci resistance zone really from about 91 to 92.5, that coincides with that low point as well as this low point over here. So clearing that reversal zone, and you'll be clearing the 200-day moving average in that case, will definitely be change the tune from what it has been a long-term bearish posture, and again still is, even with a couple little short breakouts here. But you get above those resistance level, now we've got the possibility of a long-term bullish trend in the dollar starting to ramp up again, even with this falling yield spread, which in the past has been bearish for the dollar. Of course, remember, everything's relative, and as you see, when we take a look at that economic surprise index here globally, you can see it's a lot more bullish here than it is globally. Things are really, really bearish, especially in Europe right now. Things have been bearish, and so that brings a lot of interest from overseas investors over here into the U.S. markets, where of course you have to participate in the U.S. dollar to be able to do that and exchange into that currency to do so. And usually that kind of strength would put pressure also on commodity prices, and you can see crude oil did start down and was down, gapped down today, but then rallied throughout the day, and it's actually up quite a bit off of its low for the day. You can see from the low to the high up 2.7%. And of course that's going to have an impact on energy stocks. If I were to take a look, and so this is the 3-day move where the dollar's been so strong, right? So if I were to zoom out here, the biggest loser in this last 3 days has been consumer staples, of course technology impacted by technology impacted by earnings announcements. You can see financials rallying, and also too the other asset class that's been relatively bullish here lately. In this case, it's been more over the past 4 days, has been bond yields. You can see bond prices really taking a tumble. And that's one of the reasons yields and the dollar kind of rallying together. And then, of course, inflation expectations rearing their ugly head in these higher commodity prices. And so you can see that those higher yields, if I were to zoom out now the 4 days, the impact that's having on like the real estate sector and somewhat on the utility sector, which is down and kind of matching the broad market. You can see energy stocks, financial stocks benefiting from the strong dollar, benefiting from the higher yields, and you can see the yield spread even. If I were to take a look at that yield spread again, which I've shown you before and talked about how the falling yield spread has been bearish for the financial sector. If I were to zoom out here, come on, click that on. Let's go out to a 1-year chart. So here's a yield spread, and down a little bit today with the kind of the sharper move higher in the 10 years. But you can see over the past 4 days, where financials have done well, you can see the yield spread is kind of moderated. It had been tanking down a little bit day one, up the last couple of days, down today, but still from one day to this day, over that 4-day period, the yield spread's actually a little bit higher, and that the fact that it moderated finally has really helped. Financials aren't up a lot, but they're beating the market that's down 1.5% over this 4-day period. Of course, not surprising to see industrials and especially energy stocks doing really well. And energy and material stocks have opportunities for some rotation here. As do utilities and real estate. They're going to still be under pressure until those yields stop their onward march here. They're going to be under pressure, but once they do, then there's going to be opportunity to rotate in some really good value areas in those sectors. And of course, consumer staples showing a lot of value right now. So for our trade idea of the day, I want to take a look at one of those tech stocks, that technology area is struggling here lately. One of the tech stocks that has earnings coming up this week, and that's Facebook. Facebook, you can see, has got a large market maker move. Its implied volatility is high relative to that 40-day mark, 33%, 66%. This is to kind of show you the last time we had earnings here, implied volatility right before the earnings got up to 84. Now it was, it had moved up to 84 in those last couple of days. You can see as we got closer, it went from 50 to 75, so actually 72 there, 50 there. So those February 2nd went from 50 up to 72, 75, all the way up to 84, and then it dropped off 50 percentage points. And you can see, if I were to go back here, those last couple of days to that 40-day mark, which is about where we're at here, about 39, 53 days out in that mark. Here we go. So about that March 16th is close. 34%. It rallied up to, stayed at the 33%, 32% right before the earnings, and then when the earnings came out, it dropped down about 8 percentage points. So about 8 percentage point decline after 50. So much bigger gap there than we saw, but of course we're also still another day away too. So we'll see if that number at 66% jumps up a little bit higher. As of right now, the market's looking for about a move of about $10 from the at-the-money strike. The market maker move is saying about $9, so right in that $9 to $10 area. So you say, okay, well, from a technical perspective, you can see we broke through 170, and we're kind of hitting up against 170 for resistance here. Some of these other earnings we've had some bearish responses to, but we had some bullish runs. It's a little bit different. We're on a bearish trend right now. What if we were to say, okay, let's say that instead of making a $10 move to the upside, that it makes that $10 move more towards the downside, and maybe plus or minus a little bit, and give ourselves some room to work with in case moves to the downside tend to be bigger than the moves to the upside. But what if we were to sell that 155 in April, and then come out here to this June? Remember, the June will fall too, but not as much. and buy the 155 out here. You can see I'll pay about $2.23. If I throw that into the Analyze tab, the risk profile, I'll pay about 200 bucks. If it were to go up to 175-ish, I'll lose about 80 bucks. You know, again, not accounting for any change in volatility. So if volatility were to drop similar to what it did before, then you would expect this one to drop about, you know what, to get down to 33-ish should be, you know, about 30 points. And then this one dropped about 8 points before. Oops, not 800, 8 points. So, you know, so if it makes that run up to 175, then I'll lose about, you know, 170 bucks out of the 220. But if it gets over here to this other side, you know, just from the volatility change alone, time passing, I'll make about $123. Of course, with, you know, eventually if we were to finish the week up to a potential reward of $300 by the end of the week, with a potential loss of about 170 bucks or so to the upside. So pretty decent reward to risk ratio here. Again, trying to take advantage, and what we want to do is take advantage of the fact that by the earnings options expiration, you'll get a change here, 155. So this 235 that you're going to be selling, you know, just from time passing and the stock dropping, will turn into 538. But you remember, if volatility drops, you know, was it? Let's see, this is the May, so it's this one here, April. So here's it. So if from time passing and stock dropping, the 122 bid, which is what we want to sell and get rid of, will actually move up to 258. But if that implied volatility drops 30 points, then now my Theo price is, you know, down to almost nothing. I mean, down to the same as what I eventually sold it for. Even with the stock dropping as much as it did on the put, that gains in value. So this would practically be at the money with a couple of days left. But if you take a look at this June out here, and you say, okay, well, you know, it might not drop 30 points, but let's say it drops 8 points or 7 points. We'll drop 8 points there. Then, you know, remember the other one is flat. You know, it'll be the same price at the money as what we sold it for, despite the big drop in the put with a couple of days left. This one with the big drop and the volatility dropping a little bit, you can see I will have paid $350 and I'll be up to $5. And so that's how you make money from these. And of course, if it goes up 10 bucks, then, you know, this one will lose almost all of that gain. So we'll go from $3.50 down to 50 cents, and that $3.50, that $3 loss will be offset by what would be this $1.22 gain. Yeah, you make just about all that $1.22, and that's where you get your maximum loss up here to the upside. So that's your max. You know, so that's the worst case scenario if it goes up. Of course, you know, if we were to hold on to it here, and you know, if this were to drop to minus 10 bucks, then as eventually as we get through to expiration date, of course it would be a bigger drop. But if we get through the expiration date, you can see you lose 50 cents on one more day, and of course on the last day you lose all the $1.22, as long as we stay above 155. And you remember, 150 is where you have support at that long lower shadow. You can see that if I were to eventually look at, you know, here's your 155-ish area. There's going to be some support in that area too. There's a lot of volume here, so it's gonna, you know, if we were to have that if it were to make that 10-point drop up, you know, okay, it's an earnings play. It will be off. We'll have a loss, but that loss will be offset by what we sold. You know, that really highly inflated. See, if it wasn't for that inflation, you remember this 122. You know, if it wasn't for that higher implied volatility right now, then that, you know, this option here should, instead of being priced 122, it should be priced at 13 cents. But because volatility is 30% higher than normal, we're actually getting $1.22. So we're able to buy a calendar, you know, anticipating and speculating on a drop to the downside. And if it goes to the upside, then this $1.10 will help offset some of that loss. So that's kind of smooths out and makes this calendar even more forgiving than normal because of the earnings announcements coming out. And if it does drop down to that price, then I get a pretty decent reward to risk ratio with the potential reward of about $300 if we lose all $1.22 there, and the stock down and this option, this put that I have bought, makes its way down, right? See, I bought the 155 here, it makes its way down, and of course I'll lose some volatility, but not much, and you can see it will just continue to make money as the stock drops. Well, that wraps us up for today. As always, thank you very much for watching. I hope you got some good value out of it, and this time was worth it. I appreciate those that watch it day after day. Keep coming back for more. Remember to subscribe, like, and comment down below on the video. Even if you're watching on the embedded YouTube on the Market Scholars blog, remember you can like down below. You can subscribe to our site by clicking the subscribe link at the top right corner of the page. And of course, you can also comment further down below as well on that page. And also remember too to follow on Twitter and join our Facebook community, our Market Outlook community on Facebook. As always, thank you very much. Have a great evening, everybody. We'll see you all next time.